In this chapter, we are going to look at financial statements, cash flows, and taxes. We start with the annual report. The annual report is a yearly report by which the management communicates with the firm shareholders and members of the public. There are three sections, main sections in it. The first one is a financial summary of past year's performance. The second one is information about the company, its products, and its activities. And the third part of the annual report is audited financial statements, including historical financial data. Financial statements, for example, the income statement, balance sheet, etc. Accounting in the US is supposed to be done according to the generally accepted accounting principles, or GAAP for short, GAAP. So it's a set of accounting rules and standards that companies need to adhere to when they prepare financial statements and reports. GAAP is prepared by the Financial Accounting and Standards Board, or FASB, and it is authorized by the SEC. Now, here are some accounting principles, and the first one is the assumption of arm's length transactions, which basically says that two parties who are involved in an economic transaction arrive at a decision independently and rationally. The cost principle is an accounting principle which says that transactions should be recorded at the cost at which they occurred. Now, it should not be that I buy something for $100 and I say, well, this thing is really worth $120, so I'm going to record it at $120. No, transactions need to be recorded at the cost at which they occurred. The realization principle says that revenue is recognized when the transaction is completed, while cash may not be collected until a later time. So if I have some sale which I made in this year and I completed all my obligations, I deliver the product to the customer, however, the customer only pays me next year, then the revenue recognition for me should be in my financial statement, should be in this year itself and not next year when I receive the cash. The matching principle says that expenses and revenues from an activity should be matched. So if I sell something in this period, then I should, like the cost of producing that should also be in this period. So the revenues and the cost of that item should be in the same period, because otherwise you're going to have like kind of mismatched results. The going concern assumption is that a firm will continue to operate into the predictable future. So it's not that the firm is just going to be shut down tomorrow or next year. The assumption is that it's going to continue to operate. In the US, we have the GAAP, and for other countries, there is an International Accounting Standards Board that promotes uniform accounting rules and procedures. All European Union firms are expected to comply with the International Accounting Standards since 2007. The SEC, the US regulatory body SEC, does not recognize IAS, that's the International Accounting Standard, and requires foreign firms which seek to be listed on US stock exchanges to use US GAAP. So basically the foreign firms will have to produce two sets of financial statements, one for the US and one for whichever country they are originally from. We are now going to look at the different financial statements. And the very first one, and maybe the most important one, is the balance sheet. So a balance sheet lists all assets and liabilities of a firm at a point in time. So it's what is called a stock statement. It's like you take a camera picture of the firm at a point in time. That's a stock statement. The other kind of statement are flow statements, where you look at what happens to the firm over a period of time. The left-hand side of the balance sheet shows assets the firm owns and uses to generate revenues. So that's the left-hand side. The right-hand side represents the ownership of the firm, both creditors and shareholders. So on one side is a list of assets, the other side is a list of ownership. Who has claims on the firm? Now assets are listed in their order of liquidity. So assets which can be most quickly converted to cash, which are also current assets, are listed at the very beginning. And then other assets are listed according to how much time one may anticipate it would take to convert them into cash. And therefore things like property, plant, and equipment will be listed towards the bottom. Liabilities are listed according to seniority. What that means is that the ones who need to be paid first in liabilities, the ones, the owners of the firm or the claimants on the firm who have the first right to receive money from the firm, which would be really short-term debt. So short-term liabilities would be listed at the very top. Then you would have longer-term liabilities, which are still going to be paid before the shareholders. And shareholders will be at the bottom. Common equity will be at the bottom because they will only be paid after the other claimants, other legal claimants have been paid. Now we're looking at different items in the balance sheet. And the first two that we look at are current assets and liabilities. Current assets and liabilities are assets and liabilities which can be converted to cash easily or have to be paid within a year. So all assets that will be converted to cash within a year are called current assets. So these would be things like cash, marketable securities, accounts receivable, and inventory. Current liabilities are all liabilities that have to be paid within a year. So these would be, for example, bank loans of less than 1 year maturity, accounts payable, and accrued wages. A difference between current assets and current liabilities is called net working capital. Net working capital is a measure of the ability of the firm to meet its obligations. So the greater that current assets exceed current liabilities, the more confidence you can have that the firm in the short term will be able to pay its creditors. Inventory is the least liquid of current assets. So inventory is actually goods which the firm has produced but not yet sold. And so it's least liquid. It is reported by one of two different methods on the balance sheet. So the first is called first in, first out, or FIFO, and the second is last in, first out, LIFO. Well, what this FIFO is that the first item supposed to have entered the inventory, when you have a sale, that is the item that you take out. So currently, let's say you have items of vintages 1, 2, and 3 months in your inventory. Then when you make a sale, in FIFO system, which is, so of the vintages 1, 2, and 3, which is the one which entered the inventory first? It was the one which was 3 months old, right? So you have 1, 2, and 3 month old vintages, in the inventory, and in FIFO, when you make a sale, you say the one which was the item which entered the inventory 3 months ago, that is the one which was sold. In LIFO, on the other hand, last in, first out, when you have items of different vintages in the industry, you sell the one which entered it most recently. So again, in our example where you have items of vintages, let's say 1, 2, and 3 months, so different items entered the inventory 3 months ago, then some entered the inventory 2 months ago, and some entered 1 month ago. So when you make a sale, the one you take out from the inventory is the most recent one, the one which entered the inventory a month ago. For rising, in an environment of rising prices, FIFO leads to higher current asset value and net income. Now this happens because if you have rising prices, then the inventory which was older would have needed the least amount of cost to have produced it. And if it is listed in the inventory at cost of production, then when you sell it, the gap between the sale price and the cost of that inventory is the largest compared to the gap which you would get from the sale price and the most recent inventory. So when you have FIFO, what you're doing is you're getting rid of the inventory which you're carrying at the lowest price, because that is the older inventory. Now, you should also remember that FIFO and LIFO, these are accounting systems. They don't actually relate to what the firm is actually putting in the inventory and what it is taking out. So by that I mean that, think about General Motors, and let's say General Motors has cars of 1, 2, and 3 weeks vintages in their inventory. It is most likely that General Motors just, when it wants to send some cars to its dealers, it takes the oldest vintages, the one which is 3 weeks old rather than the one which is 1 week old, and sends them to the dealers. So, however, when it makes its accounting statements, General Motors can choose to follow LIFO, in which it's just an accounting system. So it's an accounting convention, FIFO and LIFO. They do not actually relate to what General Motors is doing with its physical cars. The next item on the balance sheet are long-term assets. Now these are real assets that produce goods and generate cash flows. For example, land, buildings, property, plant, and equipment. Intangible assets such as goodwill, patents, and copyrights are also listed under long-term assets. So, long-term real assets like land, building, and equipment are depreciated, whereas intangible assets such as goodwill, patents, and copyrights are amortized. Now, depreciating asset allows a firm to lower taxable income and reduce taxes. The Internal Revenue Service allows two kinds of depreciation methods. It can either be straight line, in which you just take the price of the asset and you say, I'm going to depreciate it over 5 years. So you depreciate an equal amount every year. So you just divide it by 5, the cost, and you take that much out as depreciation. Or it can be accelerated. In accelerated depreciation, you depreciate more of the value in the nearer periods. Now what also that does, of course, is that if you depreciate it faster, it means that you have less tax in the near future compared to the far future. And that is useful for firms because there is always time value of money. So the firm would rather want to take the tax break now than wait for a later year. So here are some more items on the balance sheet. Long-term liabilities and equity. So long-term liabilities consist of long-term debt, such as bank loans, mortgages, and bonds that have maturity more than 1 year. Equity is the amount of financing which the firm has received from its equity holders, either in terms of the money which they provided to the firm at various points in time, or retained earnings. So retained earnings is really supposed to be money owned by the equity holders, and if the firm keeps it and doesn't pay it out, then you can take it as a form of financing which the equity holders are providing to the firm. So various entries for common equity on the balance sheet are par value, which was the face value of common equity sold to the equity holders, additional paid in capital, which is an extra premium which they may have paid when they purchased that equity, retained earnings, which is not really money which the equity holders have given the firm, rather it is the money which the firm produced for them and is still holding on to. And treasury stocks. Treasury stock is equity which has been repurchased by the firm. There is also preferred stock, which combines features of debt and common equity. So preferred stock is stock which is actually supposed to receive a fixed dividend, and it has to be paid before common equity is paid. So it sounds kind of like debt which also receives a fixed dividend, but unlike debt, if the firm defaults on payment to preferred stock, the preferred stockholders cannot force the firm into bankruptcy, which debt holders can. Now, when you look at a balance sheet, you may wonder that I look at these numbers and are they real? And I say that, let's say common stock is valued at $1 billion. Is it what really anybody would pay for that common stock in the market? And actually, if you go and look at, let's say, the balance sheet of Google, what you'll find is the market value of their common stock far, far exceeds the book value. And that is because the market value is based on the future profits which Google is going to produce. However, financial statements are not supposed to be forward-looking. They're not supposed to be based on what the future holds, but rather on what has been paid and for the different assets which the firm has, or the profits which it has made in the past. So accounting statements look back, whereas the market price is based on looking forward. So therefore, there exists a gap between the numbers that you see in financial statements and the market values. So the balance sheet doesn't show current market values of assets, only their acquisition cost, which is kind of, which is backward looking. Marking to market approach, that is, you say, okay, I'm going to be more forward looking, I'm going to report assets at their current market values, would provide better information. However, the downside is estimating market values. You have to estimate the market values of assets, and you may not have a good way of doing that. And of course, there's a possibility of manipulation. If a firm is facing a loss, it may say, hey, we just realized our assets are really a lot more valuable than we paid for them historically. So we're going to increase the value of assets, and that's going to push up net income, and the losses disappeared. After the balance sheet, we come to the next important financial statement, which is the income statement and the statement of retained earnings. Now, in the income statement, the basic identity is net income equals revenues minus expenses. So the income statement is actually a list of all different revenues and all different expenses. Revenues are the value of everything sold by the firm. Expenses include cost of producing goods, asset utilization costs such as depreciation and amortization. So some of these costs could actually be non-cash, like depreciation is a non-cash expense. Net income is the difference between the firm's revenues and expenses. Here are some income statement items. Depreciation and amortization. Now, depreciation is the writing off of the cost of any physical asset over its lifetime. So let's say I start a trucking business and I buy a truck. I'm not going to show the entire price of the truck as an expense in this year, because then I'm going to have this huge expense in this particular year. My net income is going to be very negative, and that is not giving you a true account of what happened, because the truck is still there for use in further years, in the future years. And so therefore what I'd like to do is I would like to divide the price of the truck into parts that will add up to the price of the truck, but will be taken as expense over the lifetime of the truck. So depreciation, once I paid for the truck and then I'm depreciating it, that depreciation expense reduces a firm's taxable income and taxes and increases cash flow because it's an expense, a non-cash expense, but it is for tax purposes allowed as an expense and therefore reduces both taxable income and taxes. There are two methods for depreciation. One is the straight line and the other is the accelerated. In straight line, the price is divided equally over the years of its lifetime, whereas in the accelerated there is more depreciation taken in the earlier years and less in the later years. What that means is that there will be more savings in the earlier years, which is something which firms prefer because they receive their less taxes earlier, which means they receive more cash earlier, and they will prefer that because of time value of money. Here are three more items of the income statement. The first is amortization. The second is non-recurring expenses. And the third is extraordinary items. Amortization is the writing off of value of intangible assets. So it's similar to depreciation, and often you'll say depreciation and amortization. Non-recurring expenses are associated with closing down of unprofitable operations or restructuring of a firm's operations. So there's something like one time, they don't happen every year. Extraordinary items refer to income and expenses associated with events that are not expected to happen on a regular basis. So of course, one of the goals of the income statement is to tell you what the net income for the firm was. But before you get to the net income, you go through some steps. And these are the bottom line income figures. So the first one, so bottom line because they are towards the bottom of the page. Now the first one is earnings before interest, taxes, depreciation and amortization, or it's called EBITDA. From EBITDA, when you take out the expenses due to depreciation and amortization, then you have left EBIT or EBIT, which is earnings before interest and taxes. So from EBIT, once you remove interest, you get the amount of earnings before taxes, which we call EBT. Now this EBT is the amount on which taxes are calculated, because interest is taken out as an expense for tax purposes. Depreciation and amortization are taken out as expense for tax purposes. So earnings before taxes is the amount on which taxes are calculated, and once from that you take out taxes, you subtract taxes from EBT, then you get net income. After the balance sheet and income statement, the next financial statement that we'll study is the statement of retained earnings. The retained earnings is a financial statement that shows changes in retained earnings over a period. The change should equal net income minus dividends. So net income is accounting estimate of how much the firm has earned for its shareholders, and from that you take out the money which it paid to the shareholders, which is going to be dividends. So the remaining would be the extra amount which it is retaining during that period. So the increase in retained earnings should equal net income minus dividends. Now you may wonder about cash flows and net income. How are they similar and how are they different? Well, they're different because there are non-cash revenues and expenses. Cash flow from operating activities equals earnings before interest and taxes minus taxes plus non-cash expenses. So the fourth financial statement we are going to look at is the statement of cash flows. And this provides you information about cash outflows and inflows during a period. So it's a flow statement. It is not a picture of the firm at a point in time. Rather, it tells you what has happened over a period of time. Now, this statement of cash flows is broken down into three parts to identify the cash flows resulting from operating activities, investing activities, and financing activities. So what are operating activities? Operating activities are the main function of the firm. It is to produce and sell goods and services. Investing activities include acquisition and sale of real assets necessary to operate the business. And financing activities are inflows and outflows due to securities sale and dividends paid, etc. Audio check, video check. Now, we are going to see the relationship between the different financial statements and how's the balance sheet related to other statements. Well, the role of the balance sheet includes bringing together all financial statements. It recognizes the changes in the company's financial position since the last reporting period. So you can look at the last period's balance sheet and this period's balance sheet to figure out the change in the company's position. It identifies the impact on the owner's equity account of all transactions that the firm was involved in since the last reporting period and recognizes in the income statement and statement of retained earnings. So the balance sheet looks at all the impact of the different information which is there in the income statement, statement of retained earnings, as I just discussed, the firm pays a tax which is based on the earnings before tax, EBT, and it pays a federal income tax. Now, the federal income tax is a progressive tax schedule. What that means is that if you have a lower income, the tax rate would be lower, and as the income keeps increasing, the next rate increases, and over the entire schedule, it can vary from about 15 to 39%. There is an average tax rate and a marginal tax rate. The average tax rate is simply the total tax that the firm pays divided by the EBT. The marginal tax rate is the tax that is paid on the last dollar earned. So that's the highest rate which the firm is paying is called the marginal tax rate. It is marginal because if the firm is making a decision, should I invest in this project and I'll have this much profit, then that profit is going to be marginal. It's going to add on to existing income, and the tax rate on that would be the marginal tax rate. So if a firm is paying taxes on income which vary from 15 to 39%, the average tax rate may be 30%, whereas the last dollar earned, the tax may be 39% on it. So the US tax rate does not treat dividend income and debt income equally. Now what happens here is that the payments, interest payments to debt is tax deductible. So the firm is allowed to say that this interest payment that I'm making on debt is an expense, and it is recognized as an expense for tax purposes. So it is subtracted from EBIT to get EBT, and therefore reducing the amount of tax which the firm has to pay. However, the dividends which the firm pays is not allowed to be recognized as an expense. So the dividends to shareholders is not allowed to be recognized as an expense. So what that does is that it favors financing by debt, and it reduces the cost of debt financing relative to equity financing. We are now going to look at some numerical questions. Here we have a firm which at the beginning of the fiscal year had retained earnings of 588,100. At the end of the year, then you again look at what's happened during the year, and during the year it generated net income of 850,540 and paid out dividends which were 35% of net income. And now the question is, what is the year-end balance of retained earnings? So you start with retained earnings of 588,100, and now I'd like to know how much are retained earnings at the end of the year, which is the same as the beginning of the next year. Well, it's going to be the beginning of the year retained earnings plus whatever is left of net income after you have paid dividends. So, so that's going to be equal to 588,100 plus, now 35% was paid out as dividends, so that leaves 65% behind. So it's going to be 0.65 into net income of 850,540, and that equals $1,140,951. So essentially what you're seeing over here is that retained earnings, as the name suggests, is earnings that have been retained by the firm and not paid out to its shareholders. So the change in retained earnings will be whatever net income has not been paid out as dividends, and therefore the new retained earnings will be the initial retained earnings plus net income which has not been paid out. Here we have a question for calculating cash flow from operating activities. Now, operating activities are the basic operations of the firm, like whatever the firm is supposed to be doing. So it's not cash flows from selling equity or cash flows from repaying debt, but it's actually the operations of the firm. So that cash flows from operating activities is linked to net income, because it's also the operations of the firm which produces the net income. However, they are different in some respects. There is a reasons why they're not exactly the same, and that's what we're going to see in this question. So we start with the net income and say, okay, the net income for this firm is 250,000. So we start with that. And then we see how it differs from cash flows from operating activities. And the first item is depreciation and amortization. Now, depreciation and amortization has been taken out of net income. While calculating net income, you say that, okay, we have to subtract depreciation and amortization. However, it is a non-cash expense. So it is not really money which the firm is paying to anyone. Therefore, as it's not been paid out, we need to add it back to net income to get cash flows. So we have 60,000 added back. What about accounts receivable increase? Now, accounts receivable increase is money which others owe to the firm. So it is money which has been taken as part of income of the firm, but the firm has not yet received the cash. So as it has not yet received the cash, we need to take it out. We need to subtract it. So we are going to say minus 45,000. After that, we have an increase in inventory of 38,000. Now, what does this mean? Now, what it means is that the firm is saying, hey, I have this new asset of 38,000. My inventory has gone up by 38,000. So, firm says that its assets have increased, and that is going to show up as positive in the net income. However, the firm has not received any money for this increase in inventory. The inventory is lying there as goods which still have to be sold. So this inventory increase needs to be reduced from net income when we are trying to figure out how much cash the firm received. So we take out 38,000. Then we have an accounts payable increase. This is what the firm owes to others, but it did not pay. So it would have been taken out, because it owes to others, it would have been taken out of net income. However, the firm did not pay the cash. So it still has the cash, so we need to add it back. Finally, other current assets decrease. Now, current assets could be like, it could be stock of other firms, or it could be T-bills. So when it decreases, it means the firm sold the stuff and it received cash. So that's not really income. However, so it's not going to be there in income. However, the firm did receive cash. So when you're trying to figure out how much cash the firm received, you have to add that. So you add 20,000 as other current assets decrease, and then you get the total of $272,000 as the cash flow from operating activities. Here we have an example of calculating net income, and a firm has revenues of 925, depreciation of 80, cost of goods sold of 400, and interest of 54. The average tax rate is 34%. So we have to calculate net income. Well, we start with EBIT, that's earnings before interest and taxes. So EBIT would be 925 minus depreciation of 80 minus cost of goods sold of 400. So this should be 445. So that's EBIT Now, earnings before taxes, you'll take out interest from EBIT. So EBT will be 445 minus 54, or that will be 391. Taxes will be 34% of EBT, or net income will be EBT minus taxes. So that will be minus taxes, so that will become 1 minus 34%, 0.34. So that is EBT minus 34% of EBT, so that is net income, and that will turn out to be $258.06. So net income is $258.06. Of course, this is could be like 258,000 or 258 million. The revenues you normally expect them to be in thousands or millions, and this is just for short that I have them only as these small numbers. Audio check, video check, thing. Here we have an example of cash flow from financing activities. And a firm has these financing activities during the year: repayment of debt of 425, issue of new debt of 650, and both of these are long term. Stock repurchases of 72 and dividends paid of 220. Now, the reason I specifically said long term is because you may remember in the cash flow from operating activities, in that example, the decrease in current assets went into operating cash flows. So current asset changes will affect operating cash flows. However, when you have long-term debt, sale or repurchase, that affects financing cash flows. So part of it is just convention. Where does that particular cash flow end up, in which one? Operating activities, financing activities, or investing activities. So that is partly convention. You may think that, okay, if current asset was like debt of some other firms which were due soon, so why is the sale or purchase of that in operating activities and not in financing activities? Well, that's convention. Okay. And some of it, of course, it's completely sensible, and that is where it should be. For example, when you sell something which the firm has produced, that definitely should be in operating activities. So anyway, coming back to this question, we have these different financing activities, and we have to find out what the net cash provided by financing activities is. Well, what is the cash inflow here? Well, there's only, of these four items, there's only one item which is a cash inflow, and that is issue of new debt. So you start with that, let's say. So the only cash inflow is 650, and then repayment of long-term debt, you take that out, so it will be minus 425. Stock repurchases, again, the firm is paying cash to repurchase the stock, so you take that out too, so that's going to be minus 72. And then dividends paid, again, that's cash, so that will be minus 220. And you do these subtractions, you are left with minus 67. So cash flow from financing activities is a negative 67.